Forex Fundamentals and Trading. Chapter 6, Central Banks and Interest Rates. Section 1, Monetary Policy Basics. Monetary policy is the process a central bank uses to influence money, credit, and financial conditions across the economy. In practice, that means guiding how easy or expensive it is to borrow, lend, save, and invest. The central bank is not controlling every price directly, but it is shaping the environment in which banks, businesses, households, and investors make decisions. Its main goal is broad economic stability, not day-to-day market management. In most modern economies, the main tool for doing this is the policy interest rate. When that benchmark rate changes, the effects spread outward through lending rates, asset prices, and eventually the currency. Most central banks are trying to achieve several goals at once, and that is why policy decisions are rarely simple. They usually want inflation to stay low and predictable, because unstable prices make planning much harder for households and businesses. Many also aim to support sustainable employment, not by creating jobs directly, but by keeping overall demand from becoming too weak or too overheated. Financial stability matters too, since credit bubbles, banking stress, or sharp market disruptions can damage the wider economy. Some frameworks also emphasize keeping long-term borrowing costs moderate. The challenge is that these goals can pull in different directions, so a decision that helps inflation might temporarily hurt growth, and vice versa. The policy rate matters so much because it acts like the starting point for borrowing costs across the financial system. When a central bank raises or lowers that benchmark, commercial banks often adjust the rates they charge on mortgages, business loans, and other credit. That change can influence whether consumers spend, whether companies invest, and whether investors prefer one market over another. It also affects bond yields and expectations about future returns. In Forex, this matters because currencies are constantly being compared to yield and policy outlook, so even a small change in the policy rate or in expectations around it can trigger a quick move in exchange rates. Expansionary policy is used when the economy is weak and policymakers want to encourage more activity. The central bank lowers interest rates, which makes borrowing cheaper for households and businesses. That can support mortgage demand, business investment, consumer spending, and sometimes asset prices as well. The idea is to make money easier to access, so demand begins to recover. This is often the kind of policy used during recessions or periods of very soft growth. But if accommodative policy stays in place for too long, stronger demand can eventually push inflation higher. Contractionary policy is the opposite approach. When inflation is running too high or the economy is overheating, the central bank raises interest rates to cool demand. Higher borrowing costs tend to slow lending, reduce some consumer spending, and make businesses more selective about new investment. Over time, that softer demand can ease upward pressure on prices. This is why tightening is often described as taking some heat out of the economy. The risk, however, is that if policymakers tighten too aggressively, they can weaken growth more than intended and even push the economy toward recession. A rate decision usually moves through the economy in stages rather than all at once. First, the central bank looks at conditions such as inflation, employment, and growth. Then it decides whether to raise, cut, or hold rates. Financial markets and banks react quickly, so yields, loan pricing, and exchange rates can shift almost immediately. Households and companies respond more gradually as they rethink borrowing, spending, hiring, and investment plans. Only later do those choices feed into broader economic activity and inflation. For traders, this timeline matters because markets often move long before the full economic effect becomes visible. One of the hardest parts of monetary policy is that it works with a delay. A rate change can affect markets quickly, but its full effect on spending, hiring, and inflation may take many months to show up. Economists call these delays policy lags. That means central banks cannot wait for perfect confirmation before acting, because by the time inflation is obvious everywhere, the economy may already be deep into the problem. They have to look ahead and make judgments about where conditions are going, not just where they are today. If they move too late, inflation can become harder to control, and if they move too early, they can slow the economy unnecessarily. Central bank independence matters because good monetary policy often requires decisions that are unpopular in the short term. Raising rates to fight inflation can hurt borrowing, housing, and growth before the benefits become visible. A government facing elections may prefer easier policy, even if inflation risks are building. An independent central bank is better positioned to focus on long-term stability instead of immediate political pressure. That does not make it perfect, but it usually improves credibility and discipline. If rates are kept too low for too long because of politics, the economy can develop larger imbalances that become even more painful later. A clear, real-world example came from the Federal Reserve in 2022 and 2023. U.S. inflation surged well above target, rising above 8% at one point in 2022, and the Fed responded by lifting rates from near zero to above 5%. Those hikes sharply increased borrowing costs across the economy, especially in interest-sensitive areas like housing. Mortgage rates rose, home demand cooled, and financial conditions became much tighter. Over time, inflation fell back to around the mid-3% area, showing that the tightening was helping restrain price pressure. Higher U.S. rates also made dollar assets more attractive, which helped support the U.S. dollar in Forex markets. A lot of confusion around monetary policy comes from oversimplifying it. One common mistake is mixing up monetary policy and fiscal policy, even though central banks control interest rates while governments control taxes and spending. Another is expecting inflation to respond instantly after a rate move, when in reality the effects take time to travel through the economy. It is also a mistake to assume low rates are always good, because cheap money can support growth in one setting and fuel inflation or asset bubbles in another. Traders also need to remember that central bank signals matter almost as much as official actions. And in Forex, global conditions matter too, because currencies respond to relative policy and international capital flows, not just domestic headlines. The core idea to keep in mind is that monetary policy is mainly about balancing inflation and growth. Central banks do that primarily by changing interest rates, which influence borrowing, spending, investment, and financial conditions more broadly. Those effects spread gradually, beginning in markets and eventually reaching the real economy. Because of that delay, policymakers have to look forward rather than react only to current data. For Forex traders, this is the foundation for understanding why currencies respond to central banks so strongly. Once you understand that interest rates shape capital flows and expectations, the next step is to compare those rates across countries. Section 2. Interest rate differentials. An interest rate differential is simply the gap between the policy rates of two countries. In Forex, that gap matters because every currency is priced relative to another one, so investors naturally compare the returns available in each. If one central bank is offering a much higher policy rate than another, that higher yielding currency may look more attractive, all else equal. This can help explain why capital moves across borders and why some currency pairs trend more than others. The differential does not guarantee a move, but it gives an important starting point for understanding demand. In practice, it helps traders think about yield, positioning, and policy advantage inside a currency pair. To calculate the nominal differential, you start with the two policy rates and subtract one from the other. For example, if the Federal Reserve rate is 5.0% and the Bank of Japan rate is 0.5%, the gap is 4.5 percentage points. But in Forex, you also need to state the result from the perspective of the pair you are trading. For USD/JPY, that differential is positive for the dollar, because the US rate is higher than Japan's. If you flip the pair to JPY/USD, the sign flips too. This matters because pair direction changes how you describe the rate advantage and how you connect it to potential price movement. Rate gaps can move currencies because capital often looks for better returns. If one currency offers meaningfully higher yields, investors may be more willing to hold that currency's bonds, deposits, or other assets. When enough money flows in that direction, demand for the higher yielding currency can increase. At the same time, the lower yielding currency may face relative pressure because it offers less income. This is one reason pairs with wide policy gaps, such as USD versus JPY during certain periods, often attract trader attention. Still, it is important to treat this as a tendency rather than a fixed rule, because other forces can interrupt or reverse the pattern. A carry trade is built directly on the interest rate differential. The basic idea is to borrow or fund in a low-rate currency and buy a higher yielding currency, aiming to collect the rate spread over time. In leveraged Forex trading, this often shows up through daily swap or rollover. That sounds attractive, but the carry itself usually accumulates slowly, while exchange rate losses can happen quickly. A sharp adverse move in the pair can wipe out weeks or months of positive carry. It is also worth remembering that the swap charged or credited by a broker may not exactly match the simple central bank rate gap, so carry trades are never just about yield. They are always yield plus FX risk. Nominal differentials and real differentials are not the same thing, and that distinction matters. A nominal differential compares headline policy rates only. A real differential goes one step further by adjusting for expected inflation, which gives a better sense of purchasing power return. For example, a country may have a higher policy rate, but if inflation is also much higher, the real return may actually be less attractive than it first appears. That is why investors often care more about real rates over longer horizons. In Forex, this helps explain why a currency with flashy nominal yields may still struggle if inflation is eroding the value of those returns. Forex markets do not wait for official rate changes. They react to expected rates. If traders believe a central bank is about to hike several times, the currency can strengthen before the first hike even happens. On the other hand, a currency can weaken while rates are still high if markets think cuts are coming soon. This forward-looking behavior is why guidance, inflation reports, jobs data, and growth figures can move exchange rates so sharply. The market is constantly trying to price the future path of policy, not just today's setting. For traders, the key question is often not where rates are now, but where they are expected to go next. Rate differentials usually matter most when markets are calm and investors are comfortable taking risk. In those periods, higher yield can be a strong attraction, and carry trades tend to work better. But in risk-off conditions, the story can change quickly. Traders may prefer safety, liquidity, or defensive currencies even if those currencies offer lower yields. That means safe haven flows can overpower a perfectly logical yield advantage. Politics, intervention risk, liquidity stress, and broader market fear can all push Forex away from the simple rate gap story. The NZD-JPY carry trade is a useful example of how differentials can support a currency pair but not control it forever. In early 2023, New Zealand's policy rate was about 5.50%, while Japan's short-term rate was around negative 0.10%, creating a very wide nominal gap in favor of the New Zealand dollar. That made NZD-JPY attractive as a classic carry setup, since traders could favor the higher-yielding NZD over the very low-yielding JPY. For a time, that yield advantage helped support the pair, but later, expectations around possible Bank of Japan tightening began to shift. As soon as markets started to think Japanese policy might become less loose, the yen strengthened and the trade began to reverse. The USD-MXN example shows how nominal and real differentials can point in the same general direction. If Mexico's policy rate is 11.25% and the US rate is 5.50%, the nominal gap is 5.50%, the nominal gap is 5.75 percentage points in favor of Mexico. If we adjust for inflation, the US real rate is about 3.0 rate is about 3.0%, while Mexico's real rate is about 3.0%, while Mexico's real rate is about 7.25%, leaving a real differential of 4.25 percentage points in Mexico's favor. That suggests the peso offers both a higher headline yield and a higher inflation-adjusted return. In calm markets, that advantage can help support MXN. But if risk sentiment deteriorates sharply, investors may still reduce exposure to higher-yielding currencies, showing again that rate advantage is important, but not absolute. Interest rate differentials are one of the most useful tools in Forex, but they should never be used in isolation. A wide gap does not automatically guarantee that the higher-yielding currency will strengthen. You also need to consider inflation, because nominal yield can look attractive while real return remains weak. Pair direction matters too, since base versus quote framing changes how you read the differential. On top of that, expectations, risk conditions, and actual broker swap costs all affect how the trade behaves in practice. The most reliable approach is to use differentials as part of a bigger framework rather than as a standalone forecast. Section 3. Inflation and currencies. Inflation means the general level of prices is rising over time. When prices go up, each unit of currency buys less than it did before, so purchasing power falls. If a basket of everyday goods used to cost $100 and later costs $100, the currency has lost some real buying power even though the number on the banknote has not changed. This is why inflation is often described as the erosion of money's value in real terms. For households, that shows up in the cost of food, rent, transport, and other essentials. For traders, it matters because currencies are ultimately claims on economies whose purchasing power can strengthen or weaken over time. In Forex, relative inflation matters more than inflation in one country by itself. Exchange rates compare two currencies, so traders need to ask which economy is experiencing faster price increases relative to the other. If one country has inflation at 6% and another has inflation at 2%, the higher inflation currency is losing purchasing power faster. Over time, that can place downward pressure on it, especially if the policy response is weak. This is why the inflation gap is often more informative than the headline number alone. Forex is always a relative gain, so inflation analysis has to be relative as well. Inflation gaps can affect exchange rates because they change how quickly each currency loses purchasing power. Suppose one economy has inflation running at 2%, while another runs at 4%. Over time, prices rise faster in the second economy, which means that currency buys less and less compared with the lower inflation one. All else equal, that can create long-run pressure for the higher inflation currency to weaken. This is closely related to the idea of purchasing power parity, or PPP. PPP is not a precise short-term trading tool, but it does help explain why persistent inflation differences matter over longer horizons. Purchasing power. Parity is the idea that exchange rates should, over long periods, adjust so similar goods cost roughly the same when converted into a common currency. If a basic basket is much more expensive in one country than another after accounting for the exchange rate, PPP suggests the currency values may be out of line. This can provide a useful long-run anchor for thinking about fair value. But in the short run, exchange rates can drift far away from PPP because capital flows, interest rates, sentiment, and policy expectations often dominate. That is why a currency can stay overvalued or undervalued for a long time. So PPP is best treated as a long horizon concept, not a timing tool for the next trade. Inflation affects currencies not only through purchasing power, but also through central bank decisions. If inflation is high, markets may expect the central bank to raise interest rates to control it. If inflation is weak or falling too much, markets may expect cuts or easier policy instead. Those policy expectations can move currencies very quickly because they change the expected return on assets in that currency. In many cases, the market reacts less to inflation itself and more to what inflation implies for future rates. That is why major CPI releases are watched so closely in Forex. Higher interest rates can support a currency, but rate hikes do not automatically create strength. The market also asks whether those hikes will control inflation without causing too much damage to growth. If traders believe the central bank is acting credibly and the economy can handle tighter policy, the currency may strengthen. But if the same rate hikes raise fears of recession, financial stress, or policy error, the currency can weaken instead. In other words, the market is judging the quality of the tightening, not just the fact that rates went up. That is why two rate hiking cycles can produce very different FX outcomes. Not all inflation sends the same message to the market. Demand pull inflation usually comes from strong spending and healthy economic momentum, so it can sometimes be interpreted as a sign of strength. Cost push inflation is different because it comes from higher input costs, supply shocks, or disruptions, such as energy spikes. That kind of inflation can hurt growth even while prices are rising, which creates a more difficult environment for the currency. So two countries can report the same headline, inflation rate, but markets may react very differently depending on what is causing it. For traders, the source of inflation often matters as much as the number itself. Inflation releases can move markets very quickly because they directly affect policy expectations. CPI is one of the most closely watched monthly reports, and PPI can sometimes offer an earlier clue about pipeline price pressure. What matters most is usually the difference between the actual reading and the forecast. If inflation comes in hotter than expected, traders may assume policy will stay tighter for longer. which can lift yields and move the currency immediately. If the data comes in exactly as expected, the reaction may be much smaller because the market has already priced it. In fast-moving markets, the surprise is often more important than the level. Credibility changes how markets interpret inflation. The same inflation reading can produce a calm response in one country and a negative currency reaction in another, depending on whether traders trust the central bank. If policymakers have a strong record of controlling inflation and communicating clearly, markets may tolerate a temporary overshoot. But if credibility is weak, investors may worry that officials are behind the curve and not acting forcefully enough. In that case, the currency can come under pressure even if the inflation number itself is not dramatically different. So market reaction depends not just on the data, but on confidence in the institution responding to it. AUD versus JPY gives a practical example of how inflation and policy can combine in Forex. Australia had inflation above 6% and policy rates around 4.1%, while Japan had inflation closer to 3% but kept rates near negative 0.1%. That created a large policy gap in favor of Australia, and the Bank of Japan remained much looser than the Reserve Bank of Australia. As a result, AUD-JPY was supported and rose from roughly 88 to 96 over that period. But traders were still careful about the quality of Australian inflation, asking whether it reflected strong demand or less constructive supply-side pressure. So even when the pair was rising, the market still had to judge the underlying inflation story. There are several common mistakes that weaken inflation analysis in Forex. One is focusing only on nominal yields and ignoring real returns, which can give a very misleading picture. Another is analyzing just one country, even though exchange rates always compare two economies at once. It is also a mistake to treat all inflation as if it means the same thing, since demand-driven inflation and supply-driven inflation can have very different implications for growth and policy. Traders also get into trouble when they ignore expectations and guidance, because markets often price the likely policy response before the data is even released. The strongest inflation analysis stays relative, policy-focused, and aware of what is already priced in. A good way to practice this framework is to compare the United States and Canada through both inflation and policy rates, then translate that into a USD/CAD view. Start by finding the latest year-over-year CPI reading for each country. Then, record the current Federal Reserve rate and the Bank of Canada rate. From there, calculate the inflation differential and the rate differential to see which side has the relative advantage. Finally, explain how those differences might influence USD/CAD, remembering that the pair reflects the dollar relative to the Canadian dollar. This kind of exercise builds the habit of thinking in relative terms, which is essential in Forex. Section 4. Hawkish versus dovish policy. Hawkish and dovish are terms traders use to describe a central bank's policy tone. A hawkish tone places more emphasis on controlling inflation and often suggests higher rates or tighter policy may be needed. A dovish tone puts more weight on supporting growth and employment, often pointing toward lower rates, easier policy, or less urgency to tighten. These labels are helpful because markets care not only about what happened today, but also about what policymakers seem likely to do next. In Forex, tone can matter as much as the actual rate decision because it changes expectations about future yield. So when traders call a statement hawkish or dovish, they are really talking about policy direction. It is important to remember that hawkish and dovish are not fixed identities. A central bank is rarely fully one or the other all the time. Markets usually judge whether the tone is more hawkish or more dovish than before, or compared with what was expected. Even if the policy rate stays exactly the same, the message can still shift along that spectrum. A statement that sounds slightly more concerned about inflation than the previous one may be taken as hawkish, even without a rate move. In practice, the market is always asking a relative question, not applying a permanent label. Markets react to two things at a policy meeting: the decision itself and the guidance about what may come later. A central bank can hold rates steady and still sound hawkish if it signals more tightening is possible or says inflation remains too high. It can also hold rates and sound dovish if it emphasizes slowing growth or suggests cuts may come sooner than expected. This is why traders read statements, watch press conferences, and study meeting minutes. Those forms of communication help shape the expected path of future rates. In many cases, the guidance has a bigger market impact than the decision printed in the headline. Certain phrases often hint at policy bias, but they need to be read in context. Wording such as inflation remains too high or further tightening may be needed usually sounds hawkish because it suggests concern about price pressure and a willingness to keep policy restrictive. By contrast, phrases like growth is weakening or policy may become less restrictive sound more dovish because they point toward caution about tightening too much. The key is not to isolate one sentence and overreact. Traders compare the full statement with prior messaging and with the broader economic backdrop. A phrase that sounds hawkish in isolation may matter less if the rest of the statement is more balanced or cautious. Central bank tone moves currencies because it changes expectations about future interest rates. If communication turns more hawkish, traders may start pricing higher yields ahead, and that can support the currency. If communication turns more dovish, expected yields can fall, which may weaken the currency. Bond yields often move alongside those changing expectations, so Forex and rates markets usually reprice together. This is why a speech, statement, or press conference can move the market even if the official rate does not change. What matters is whether the communication changed the expected path of policy. The market reaction process usually follows a clear sequence. First, the central bank releases a decision along with its message. Then, traders compare that message with what they were already expecting, asking whether it was more hawkish, more dovish, or roughly in line. If the communication changes the expected path of future rates, markets reprice bond yields, futures, and other assets. Finally, currencies adjust to that new outlook as traders shift positions. Understanding this sequence helps explain why the same headline can produce different reactions depending on what the market had priced beforehand. An unchanged rate can still trigger a meaningful move if the tone shifts. Imagine the Reserve Bank of Australia leaves the cash rate at 4.10%, so the decision itself contains no surprise. But suppose the wording becomes more inflation-focused and states clearly that inflation remains too high. Compared with earlier neutral language, that sounds more hawkish. Traders may then decide future hikes are more likely, or at least that cuts are further away than they previously thought. Even without a rate increase today, bond yields and the Australian dollar can still rise because the message changed the outlook. Once traders interpret a message as more hawkish, they usually adjust several things at the same time. They may buy the currency, pushing something like AUD/USD higher. They may also raise short-term bond yields as they price in a greater chance of future tightening. Rate probabilities in futures markets can shift quickly, even if the central bank did nothing on that particular day except change its tone. This is a good reminder that expectation changes alone can move price. The market is responding to a revised path, not just to the current setting. Relative policy matters in Forex because a currency is never judged alone. A central bank can sound hawkish compared with its own past, but the currency may still fall if the other central bank in the pair is even more hawkish. This happens because exchange rates reflect relative differences in yield and expected policy path. So it is not enough to say one central bank is tightening. You have to ask whether it is tightening more or less aggressively than the one on the other side of the pair. In Forex, relative policy often matters more than absolute policy. A few interpretation mistakes show up again and again around central bank communication. One is treating a rate hold as neutral even though a hold can carry a very hawkish or very dovish message. Another is ignoring the economic backdrop, since inflation, growth, and financial conditions shape how the words should be read. Traders also get misled when they focus too heavily on one sentence or one official instead of the full message over time. And in Forex especially, it is a mistake to forget the relative comparison across currencies. The best reading comes from combining the statement, the context, and the cross-currency contrast. Section 5. Currency reactions to policy. After a policy meeting, the biggest driver of FX is usually not the decision itself, but the gap between expectation and reality. If the market expected a hike and got exactly that, the currency may barely move or may even fall if traders were hoping for something stronger. If the outcome is more hawkish than expected, the currency often rises because traders must reprice the future path of rates. If it is less hawkish or unexpectedly dovish, the currency can weaken quickly. This is why a cut can have little effect when fully priced in, while a small surprise can trigger a large move. In short, surprise is what tends to move price. Interest rates usually matter because they influence the return available on assets denominated in a currency. Higher rates can make that currency more attractive to investors, while lower rates can reduce its appeal. But the relationship is never automatic. A rate increase that was fully expected may do very little for the currency, while an unexpected hike can have a much stronger effect. The market is always comparing what changed against what was already priced. So yield matters, but only within the larger context of expectations and market positioning. Before each central bank meeting, the market builds a baseline expectation. Traders use inflation data, jobs numbers, growth trends, speeches, and prior guidance to estimate what the central bank is likely to do. By the time the announcement arrives, some of that view has already been priced into yields and currencies. The actual decision is then judged against the consensus. If the rate matches expectations, attention often shifts to the statement and tone. If the decision differs from consensus, the reaction can be much larger because the market has to adjust quickly. Forward guidance can outweigh the decision because markets care deeply about what comes next. A central bank can leave rates unchanged today, but if its statement suggests inflation is persistent and more tightening may still come, the currency may rise. On the other hand, a rate hike can disappoint if policymakers sound cautious and hint that the tightening cycle is nearly over. Press conferences, economic forecasts, and official projections often shape this interpretation. Traders are constantly updating the future rate path, not just reacting to the current move. That is why communication around the decision can be more important than the decision itself. The same policy action can trigger very different FX reactions depending on the broader context. A rate hike in a strong economy with persistent inflation may be seen as supportive, disciplined, and positive for the currency. But the same hike in a weak economy may look dangerous, as if the central bank is risking recession or policy error. Inflation backdrop matters too, because tightening against strong demand is different from tightening into a supply shock. Markets are also judging whether the decision signals confidence or concern from policymakers. So context helps explain why textbook relationships do not always hold in real time. The phrase "buy the rumor, sell the fact" describes a common market pattern around central bank meetings. Traders often position before the event based on what they expect to happen, so the currency may already have moved significantly in advance. When the expected outcome is finally announced, there may be little new information left to drive further gains. At that point, profit-taking can cause the move to stall or reverse. This is especially common when the announcement matches consensus closely. Bigger follow-through usually requires a genuine surprise, not just confirmation of what everyone already believed. Consider a simple example with the Bank of England and GBP/USD. Suppose the market widely expects a 0.25% hike, and sterling rises before the meeting as traders position for that outcome. The bank then delivers exactly the expected hike. At first, the reaction is small because the decision itself is not new information. But if the guidance sounds cautious, or if traders simply take profit after the pre-meeting rally, GBP/USD can slip lower afterward. So even though the bank hiked rates, the currency ends up weaker because the market had already priced the headline and then reassessed the outlook. Different combinations of decision, guidance, and surprise can produce very different FX outcomes. An expected cut that is fully priced in may lead to only a small move. No change paired with hawkish guidance can lift a currency because future tightening becomes more likely. A rate hike combined with dovish language can push the currency lower if traders conclude the cycle is almost over. And a larger than expected move can trigger the strongest repricing because the whole path of future rates may need to be adjusted. This is why traders should think in scenarios rather than relying on a single rule. When a currency moves after a central bank meeting, it helps to use a simple checklist. First, ask what the market expected before the meeting, because that sets the baseline for interpretation. Second, compare that expectation with what was actually announced. Third, read the guidance to see what the statement implies about future meetings and the likely path of policy. Fourth, Think about positioning, since a crowded long or short market may react differently even to neutral news. And finally, place the move in the broader economic picture so you do not overreact to the headline alone. Most mistakes around policy events come from focusing too narrowly on the headline. Traders often look only at the rate decision and ignore the statement, guidance, and press conference that actually shape expectations. Another common error is assuming hikes always strengthen a currency, even when the move was fully priced or paired with dovish language. Ignoring pre-meeting pricing is also costly, because much of the move may have happened before the announcement, and trading the event without a plan can be dangerous when volatility spikes. A better approach is to work through expectation, decision, guidance, and price action together before acting.